In September 2008, the global financial system came within hours of total collapse. Banks that had stood for over a century vanished overnight. 8 million Americans lost their jobs. 10 million lost their homes. The stock market lost over 50% of its value. And it all started with one simple idea. Give mortgages to people who can't pay them back, then sell the risk to someone else. This is the complete story of the 2008 financial crisis, the worst economic disaster since the Great Depression, and how the people who caused it got bailed out while everyone else paid the price. Traditionally, a bank that gave you a mortgage held it for 30 years. If you defaulted, the bank lost money. This gave banks a strong incentive to only lend to people who could pay. Then came securitization. Banks started bundling thousands of mortgages together into a single financial product called a mortgage-backed security, an MBS. They sold these bundles to investors who collected the monthly payments as income. The bank made money on fees, the investor got steady returns, and the homeowner got a loan. Everyone won. But there was a catch. Once the bank sold the mortgage, the bank no longer cared if you paid it back. The risk was someone else's problem, and that changed everything. With no risk of holding bad loans, banks had one incentive: volume. More mortgages meant more fees. Lending standards collapsed. Banks offered subprime mortgages, loans to borrowers with poor credit, low income, or no documentation. Ninja loans emerged: no income, no job, no assets. Adjustable rate mortgages lured borrowers with low initial rates that would spike after 2 years. Borrowers were told house prices always go up. They could refinance before the rate adjustment. Mortgage brokers earned commissions per loan, regardless of whether the borrower could afford it. Between 2003 and 2006, subprime lending exploded from 8% of mortgage originations to 20%. The pipeline needed volume. Quality didn't matter. Here's where it gets sophisticated and dangerous. Investment banks took bundles of mortgage-backed securities, many packed with subprime loans, and repackaged them into collateralized debt obligations, CDOs. A CDO was structured in layers called tranches. The top tranche got paid first. Lowest risk, lowest return. The bottom tranche absorbed the first losses. Highest risk, highest return. The theory was diversification. Even if some mortgages defaulted, the pool was large enough that the top tranches would be safe. Rating agencies, Moody's, Standard & Poor's, Fitch, agreed. They rated the senior tranches of CDOs AAA, the same rating given to U.S. government debt. AAA meant pension funds, insurance companies, and retirement accounts around the world could buy them. And they did. Trillions of dollars worth. As CDOs multiplied, a new market emerged: credit default swaps, CDS. A CDS was essentially insurance on a CDO. If the CDO defaulted, the CDS seller paid the buyer. But here's the critical difference. You didn't have to own the CDO to buy insurance on it. That's like buying fire insurance on your neighbor's house. Multiple parties could bet on the same CDOs. AIG, the world's largest insurance company, sold over $400 billion worth of credit default swaps. They collected premiums assuming the CDOs would never default because they were rated AAA. They didn't set aside reserves to cover potential payouts. The entire system was built on the assumption that house prices would never fall nationally. In 2006, U.S. house prices peaked and began to decline, for the first time nationally since the Great Depression. Subprime borrowers with adjustable rate mortgages saw their payments spike. They couldn't refinance because their homes were now worth less than their loans. Defaults surged. The bottom tranches of CDOs were wiped out first. Then the middle tranches. Then the senior tranches, the ones rated AAA. Losses cascaded through every institution that held them. Bear Stearns collapsed in March 2008. Fannie Mae and Freddie Mac were seized by the government in September. Lehman Brothers, the fourth largest investment bank in America, filed for bankruptcy on September 15, 2008. It was the largest bankruptcy in U.S. history, $639 billion in assets. The next day, AIG told the government it couldn't cover its credit default swap obligations. It was insolvent. If AIG failed, every bank that had bought CDS protection from AIG would be exposed simultaneously. But that's another story. the 30-year mortgage that created the foundation for this entire system. On October 3, 2008, Congress passed the Troubled Asset Relief Program, TARP, authorizing $700 billion in taxpayer funds to stabilize the financial system. The Federal Reserve went further. It ultimately committed over $16 trillion in emergency lending programs to banks and financial institutions worldwide. AIG received $182 billion in government support. The banks that caused the crisis were deemed too big to fail. Their collapse would have destroyed the entire payment system, frozen credit markets, and triggered a global depression. The money saved the banks. It did not save the homeowners. Over 3.8 million foreclosure filings were processed in 2010 alone. Ordinary Americans lost their homes, their savings, and their jobs, while the institutions that created the crisis were made whole. Out of all the major Wall Street executives, exactly one went to prison. Kareem Sarah-Geldin, a mid-level Credit Suisse executive, served 30 months for hiding losses. No CEO of any major bank was criminally charged. The Department of Justice pursued civil settlements instead. J.P. Morgan paid $13 billion, Bank of America paid $16.65 billion. Goldman Sachs paid $5 billion. These sound large, but they were fractions of the profits these banks made. For many institutions, the fines were simply a cost of doing business. The crisis produced the Dodd-Frank Act in 2010, the most sweeping financial regulation since the 1930s. It created the Consumer Financial Protection Bureau, imposed stress tests on major banks, and restricted some proprietary trading through the Volcker Rule. Banks are better capitalized now than in 2008, but many Dodd-Frank provisions have been weakened or rolled back. Subprime lending has shifted to auto loans. Americans now owe $1.6 trillion on their cars. And the fundamental incentive structure, originate, package, sell, still exists. The instruments have changed. The architecture hasn't. The 2008 crisis was driven by a combination of borrower speculation, government housing policies, and a financial system that packaged and sold risky loans, because every link in the chain profited regardless of the outcome. The house of cards fell. The builders got bailouts. Everyone else got the bill.